What if I told you the absolute greatest wealth building secret in the world is actually kind of the most boring? Welcome to this explainer. Today, we're diving into a topic that's absolutely crucial for anyone looking to secure their financial future. We're going to break down why the S&P 500 is universally considered the absolute gold standard for long-term wealth building. Seriously, have you ever wondered why financial experts and self-made billionaires are so completely obsessed with this one specific index? Well, we are going to unpack the data and the reasoning right now.
So think about it for a second. How do you just skip the headache of complicated stock picking, completely ignore those confusing corporate balance sheets, and instead instantly grab a piece of America's top 500 companies? Imagine never having to guess which industry is going to blow up next or lying awake worrying you picked the wrong horse. With the S&P 500, you're essentially buying a slice of the 500 most powerful companies in the country, literally with just a single click.
Today, we're unpacking the top 5 reasons this index consistently beats Wall Street. Instant diversification, historical returns, low costs, market resilience, and simplicity. By the end of this, you're going to see exactly how this index can turn small, regular monthly contributions into a truly massive nest egg.
All right, let's jump right into reason number 1, instant diversification.
You know, the biggest beginner mistake in the investing world is buying just 1 or 2 stocks that you happen to like. Because if that specific company has a rough year or a major product completely flops, your entire portfolio tanks. It's a huge, unnecessary risk. But the S&P 500 fixes this right out of the gate by acting as a highly diversified basket spread across 11 major sectors of the economy. We're talking massive tech giants, retail kings, healthcare innovators, and energy companies. The beauty here is that if one sector is having a down year, another is usually up. It safely spreads out your risk, making sure your financial future isn't recklessly tied to the success or failure of just one CEO.
Moving right along to reason number 2, and this is the fun part: historical returns.
Look, it's one thing to protect your money, right? But it is a whole different ballgame to grow it substantially over time. Since it was officially created back in 1957, the S&P 500 has pumped out a remarkable average annual return of roughly 10.5%. That is decades of incredibly consistent, proven performance powering the growth of everyday investors' portfolios. To really translate that percentage into real-world impact, let's look at a concrete example. If you had invested just $10,000 30 years ago and then did absolutely nothing, no day trading, no panic selling, you literally just left it completely alone, it would have compounded into over $170,000 today. That is the sheer, unstoppable magic of compound interest driven by this specific index.
Now, obviously, the market absolutely does not go straight up every single year. But historically, the S&P 500 finishes in the green 74% of the time. Just think about that win rate. It makes it arguably the most reliable wealth creation engine in history.
Okay, let's hit reason number 3, low costs. This is all about keeping your money working for you. An actively managed mutual fund might charge you 1, maybe even 2% in management fees just to pay a team of guys in suits trying to beat the market. But because the S&P 500 is passive, meaning a computer is simply tracking a set list of companies, the fees are practically zero. Passive S&P 500 ETFs like VOO or SPY charge as little as 0.03%. We are talking about a night and day difference in efficiency here.
And I get it. A 2% fee sounds absolutely tiny when you say it out loud. But over 30 years, that tiny little fee can silently cannibalize up to 40% of your total wealth. 40%! That proves that a low-cost passive approach keeps the compounding money exactly where it belongs, in your pocket instead of buying your broker a new sports car.
Which brings us perfectly to reason number 4, market resilience, the ultimate survivor.
Think about all the massive shocks we've lived through. 1987's Black Monday, the absolute meltdown of the 2008 financial crisis, the sudden, terrifying 2020 global pandemic. The S&P 500 has faced and survived every major war, recession, and panic of the last 70 years. It continuously bounces back from historical shocks that had everyone convinced the sky was falling.
So why does it always recover? Well, it survives because the index is essentially self-cleansing. It's a brilliant structural advantage. If a company stops performing and loses its value, it just gets kicked out of the index, and then it's immediately replaced by a new, growing, profitable company. This means you aren't stuck holding the bag on dead weight. You are always automatically betting on the long-term ingenuity and forward momentum of the entire U.S. economy.
Finally, we arrive at reason number 5, simplicity, the ultimate set and forget strategy.
You really don't need a finance degree to win this game. In fact, legendary investor Warren Buffett famously recommends this exact straightforward strategy for the everyday person. He even won a highly publicized million-dollar bet, proving that a simple, basic S&P 500 index fund could completely crush a hand-picked portfolio from top Wall Street hedge funds over a decade. No way you can ignore that.
And the actual execution of the strategy? It's wonderfully boring. No daily trading, no stressing over the nightly business news, just 3 straightforward steps. Set up an automatic monthly contribution, use dollar-cost averaging, and just let time do all the heavy lifting for you.
Ultimately, this is absolutely not a flashy get-rich-quick scheme. It is a highly structured, remarkably reliable strategy to get wealthy for sure over the long term. It definitely requires patience, but the history and the math back it up entirely. So I'm going to leave you with this final provocative thought. Knowing all the proven data on instant diversification, those massive historical returns, the low fees, the resilience, and the sheer simplicity of it all, are you ready to embrace the index fund, or do you still prefer the thrill of trying to pick individual stocks? It's a massive decision for your financial future. Thank you so much for joining me for this explainer, and I really hope this gives you a much clearer picture of your investing options.